In 2024, S&P 500 companies spent $942.5 billion buying back their own stock. Not building factories, not hiring engineers, not developing new products, buying their own shares, canceling them, and making themselves smaller. That number set an annual record, and by the trailing 12 months ending September 2025, the total crossed $1 trillion for the first time in history. Public companies don't always reinvest their profits. Increasingly, they shrink themselves, and the mechanics of how that works and why every CEO in America has a rational incentive to keep doing it explains more about the modern economy than almost any other single concept. So let's start with the basics. What does a stock buyback actually do? A company earns profit. It has cash sitting on the balance sheet. The board of directors has a few options. They can invest it back into the business. They can pay a dividend directly to shareholders. Or they can go into the open market, buy their own shares, and retire them, remove them from existence. When you reduce the number of shares outstanding, something mechanical happens to a metric called earnings per share, or EPS. EPS is net income divided by shares outstanding. So if a company earns $10 billion and has 1 billion shares, EPS is $10. Now the company spends $5 billion buying back stock and retires 50 million shares. Next quarter, even if net income stays flat at $10 billion, EPS jumps because you're dividing by 950 million shares instead of a billion. Earnings per share goes up without the company actually earning more money. This matters enormously because EPS growth is the single most watched metric on Wall Street. It drives analyst upgrades, price targets, and stock valuations. When a company reports rising EPS quarter after quarter, the stock price tends to follow. Investors see growth. The chart goes up and to the right. Everyone is happy, and the company didn't have to sell a single additional product to make it happen. Now, you might ask, why not just pay a dividend instead? Dividends and buybacks both return cash to shareholders, but they work very differently. A dividend is a direct cash payment. You own the stock, you get a check. Straightforward. But dividends come with two problems for corporate management. First, they're taxed as income the year they're received. Buybacks defer the tax event until the shareholder sells. Second, and more importantly, dividends create expectations. Once a company establishes a quarterly dividend, cutting it is treated as a crisis. Stock prices plunge on dividend cuts. Analysts downgrade the company. It signals weakness. So dividends are sticky. They're commitments. Buybacks are discretionary. A company can announce a $50 billion buyback authorization and execute $10 billion of it, or none of it, with no consequences. They can accelerate when times are good and pull back when things get tight. The flexibility is enormous, and CFOs love flexibility. That's the mechanics. Simple enough. But here's the question worth asking. Why did buybacks go from a minor corporate activity to nearly $1 trillion annual industry? The answer starts with a single regulatory change in 1982. Before that year, companies buying their own shares on the open market operated in a legal gray zone. The SEC's anti-manipulation rules under Section 10B of the Securities Exchange Act meant that large-scale open market repurchases could be treated as a form of market manipulation. Companies were cautious. They avoided routine buybacks because the legal risk was real. Then, in November 1982, the SEC adopted Rule 10b-18. It created what's called a safe harbor. If a company followed certain conditions regarding timing, volume, price, and the number of brokers used, it would be shielded from manipulation liability. The rule didn't mandate anything. It didn't say buybacks were good or bad. It simply reduced the legal uncertainty, and the effect was immediate. According to one study cited by Congress, buyback volume tripled in the year after the rule took effect. The floodgates didn't just open, they were removed entirely. But the rule change alone doesn't explain why buybacks accelerated for 4 straight decades. To understand that, you need to follow the incentive structure built on top of it, and the most important piece of that structure is how CEOs get paid. In 2024, average realized compensation for CIOs at the top 350 U.S. firms was $22.98 million. Of that, 79% came from stock-related pay, not salary, not cash bonuses. Stock options and stock awards that vest based on performance targets, most of which are tied directly or indirectly to stock price and EPS growth. In 1978, the CEO to worker pay ratio was 31:1. By 2024, it was 281:1, and the entire expansion of that gap was driven by the stock-based component. So think about what this means for capital allocation. You're a CEO. Nearly 80% of your total compensation depends on stock. Price performance. You have a pile of cash on the balance sheet. You can invest it in a new product line that might pay off in 5 years, or you can authorize a buyback that mechanically lifts EPS this quarter, triggers your performance targets, and directly increases the value of your vested stock. The choice isn't complicated. It's not even close. And it's not just the CEO. Institutional investors, the pension funds and asset managers that hold the majority of public equities, evaluate companies on short-term earnings performance. A portfolio manager at a large fund is measured quarterly. If a stock in their portfolio misses EPS estimates, the manager looks bad. If it beats estimates, they look smart. Buybacks are a tool that companies use to consistently meet or beat those estimates, especially when organic growth slows down. The analyst community reinforces this further. When a company announces a major buyback, it's treated as a bullish signal, a vote of confidence. The company is saying, we believe our stock is undervalued and we're putting our money behind it. The stock typically pops on the announcement alone. Everyone in the chain, the CEO, the board, the analysts, the portfolio managers, benefits from the same action. That's not conspiracy, it's alignment. A system built to reward one specific behavior, and then everyone in the system behaving exactly as you'd expect. But here's where the conversation gets more interesting. Because every dollar spent on buybacks is a dollar not spent on something else. Take Apple, the most profitable company in the world. In fiscal year 2023, Apple spent $30 billion on research and development. It spent $77 billion on stock buybacks. That's more than 2.5 times as much money going back to shareholders as into creating new products. Since 2013, Apple has spent over $700 billion on buybacks. Its share count has declined by roughly 40%. And the result is that even in years where revenue was flat or net income actually declined, EPS still grew. Fiscal 2023 is the perfect example. Apple's net income fell by about $2.8 billion year over year, but because the company retired over 500 million shares through buybacks, EPS actually increased. On paper, it looked like growth. In reality, the underlying business had contracted slightly. Now, Apple defenders will argue correctly that the company simply generates more cash than it can productively deploy. At $30 billion a year in R&D, Apple already spends more on research than most countries spend on their entire technology sectors. You can't just triple R&D spending overnight without turning your research operation into a bureaucracy, and that's a fair point. The question isn't whether any single company is doing something wrong. The question is what happens when this becomes the default behavior across an entire economy. And that brings us to Boeing. Between 2013 and 2019, Boeing spent $43 billion on stock buybacks, more than the company's total profits during that period. At the same time, capital expenditures, the spending on actual manufacturing equipment and facilities, fell to less than 2% of sales by 2018. That was half what European rival Airbus typically spent. In 2017, the year before the first fatal 737 MAX crash, Boeing's combined spending on dividends and stock buybacks consumed 66% of its total cash outflows. Just 9% went to new manufacturing equipment. Payouts to shareholders were 7 times larger than investment in production capability. Meanwhile, executive compensation was restructured in 2014 so that a significant portion of long-term incentive pay was tied to total shareholder return relative to a peer group. If shareholder return is the primary metric by which you judge executive performance, buybacks become the most efficient tool in the kit, and Boeing used them aggressively. Rather than spend an estimated $7 billion to design an entirely new narrow-body aircraft to compete with the Airbus A320neo, Boeing chose to modify the existing 737 airframe and attach larger engines. The modification approach was cheaper, it preserved cash for shareholder returns, and the result was the 737 MAX. 2 crashes, 346 people dead, a worldwide fleet grounding, and a company that went from being America's largest exporter to facing criminal fraud charges. The irony is that $7 billion, the approximate cost of a clean sheet design, is roughly what Boeing was spending on buybacks every single year during that period. Now it would be inaccurate to say buybacks caused the 737 MAX crashes. Engineering failures, regulatory capture, and management culture all played critical roles. But the capital allocation pattern tells you something about where the priorities were. The system wasn't built to ask whether the company needed a new airplane. It was built to ask whether the stock price would be higher next quarter, and the stock price said do the modification. This is the trade-off that rarely gets examined clearly. Not because it's hidden, but because it operates within the logic of the system. Buybacks versus R&D. buybacks versus wages, buybacks versus capital expenditure, buybacks versus long-term competitive positioning. Every dollar that flows into a repurchase program is a dollar that doesn't flow into the operating future of the business. And when 79% of CEO pay comes from stock performance, and when the single most reliable way to boost stock performance in the near term is to reduce share count, the allocation decision is structurally predetermined. You don't need to accuse anyone of negligence or bad faith. The incentives are doing exactly what incentives do. And this leads to what you might call the machine effect. Buybacks aren't a one-time event. They're a self-reinforcing loop. A company does buybacks. EPS rises. The stock price goes up. Executive compensation targets are hit. Analysts upgrade the stock. More investors pile in. The company generates more cash. And the board authorizes another round of buybacks. The cycle repeats. Year after year. Quarter after quarter. Each round of repurchases makes the next round more necessary because now the market expects that level of EPS growth. If you stop buying back stock, EPS growth slows, the stock drops, and the CEO's compensation takes a hit. So you keep going. You keep feeding the machine. And here's the part that makes this especially durable. Most companies running large buyback programs operate in consolidated industries. Apple dominates smartphones. Boeing and Airbus split commercial aviation. A handful of banks control most consumer lending. These aren't companies facing scrappy upstart competitors that force them to reinvest or die. They're oligopolies. They have pricing power, stable margins, and limited competitive threats. That safety net is what allows the buyback machine to run for decades without triggering an immediate crisis. A company in a fiercely competitive market that diverted all its cash to buybacks would get out-innovated and go under. But when you control 50 or 70% of your market, you can underinvest for a very long time before anyone notices. The erosion is slow. Products get incrementally less innovative, manufacturing quality drifts, engineering talent goes elsewhere, but the stock price keeps climbing because EPS keeps growing because shares keep getting retired. The market tells you everything is fine right up until the moment it isn't. The 12-month period ending September 2025 saw S&P 500 companies spend a record $1.02 trillion on buybacks. That same period, the top 20 buyback spenders accounted for nearly half the total. Apple alone spent $96.7 billion over that stretch. Nvidia spent $51.8 billion. Meta spent $44.2 billion. JP Morgan Chase spent $27.6 billion. These are the largest, most dominant companies in the American economy, and collectively they are spending more money shrinking their share counts than most industries generate in total revenue, and the concentration is increasing. The top 20 now represent a larger share of total buybacks than at any point before the pandemic. None of this is irrational. That's the essential thing to understand. Every actor in the system is behaving logically given the incentives they face. CEOs are maximizing their compensation. Boards are responding to institutional investor pressure. Analysts are rewarding EPS beats. Portfolio managers are chasing quarterly performance. And the regulatory framework, unchanged in its fundamental structure since 1982, continues to provide the safe harbor that makes it all frictionless. The system works. It does exactly what it was designed to do. It just wasn't designed to prioritize the things most people assume corporations exist to do, which is build products, employ people, and invest in the future. The buyback machine doesn't destroy companies overnight. It slowly transforms what they're built to do. It turns manufacturers into financial vehicles. It turns innovation budgets into shareholder return programs. It turns long-term competitive strategy into quarterly EPS management. And it does all of this within the rules, within the incentives, within the logic of how public markets currently operate. The question isn't whether buybacks are good or bad. The question is what you're optimizing for. Because the system has already answered that question, and it answered it a long time ago. Thanks for watching. If you found this useful, hit that like button and subscribe for more stories of money legends. And if you think the buyback machine was something, wait till you see what we're covering next. We think you'll love it. Click here to watch.